Most people, and honestly, even some professionals, think trust accounting is just glorified bookkeeping. You know, keep the client's money in a separate account, pay it out when you're supposed to, and you're golden as a CPA who has spent decades cleaning up financial messes. I can tell you that this belief isn't just wrong, it's a career-threatening mistake. What most people don't see are the hidden rules, the rigid procedures, and the razor-thin margin for error. That simple bookkeeping is actually a high-stakes tightrope walk, and I'm going to show you how to get to the other side without falling. In the world of professional services, few areas carry the same personal and professional risk as managing client trust funds. We're talking about money that isn't yours, and a single mistake, even an honest one, doesn't just need a quick fix. It can lead to losing your license, facing legal action, and destroying a reputation you've spent a lifetime building. And no, these consequences aren't just theoretical threats. They are very, very real. Oh, my CPA, and I've spent my career in the financial trenches. I'm the person law firms and other professionals call when things go sideways to conduct forensic audits, untangle the mess, and build systems that prevent disasters from ever happening again. I have seen firsthand how tiny oversights in trust accounting snowball into career-ending catastrophes. That's why I'm making this video. My promise to you is simple. In the next few minutes, we're going to expose the 3 most common and dangerous failure points I see time and time again. More importantly, I'm going to give you the practical, actionable daily and monthly procedures that separate the amateurs from the pros. These systems that will protect you, your firm, and your clients. The biggest and most common myth is that a trust account is just a fancy checking account. It's a temporary holding pen for money, and as long as the bank statement balances, everything's fine. Right. Wrong. 2. This mindset is the root cause of nearly every compliance failure because it completely misunderstands what that money represents. That money is never yours. Not a single penny of it. It belongs to a specific client for a specific purpose. And your job isn't just to balance an account. It's to track every single cent's journey, every single day. As CPA, advising firms on this, your role goes beyond math and becomes about fiduciary integrity. You are a guardian of other people's money. The records you keep are your proof that you've upheld that duty. An auditor from a state bar isn't going to ask if your account balanced. They will ask you to prove, with an ironclad audit trail, where Mrs. Smith's $10,000 retainer went. Who authorized the $500 payment for an expert witness, and why a check was cut on a specific date? A balanced bank statement can't answer that. Only rigorous daily habits can. This brings us to the solution, a set of unbreakable daily procedures. First, meticulous record keeping for every single transaction. This is non-negotiable. A generic description in your ledger is a huge red flag. An entry for a deposit that just says client payment is useless. A withdrawal that says legal services is an open invitation for a painful audit. Why? Because it tells you nothing. You have to be specific. A proper deposit entry looks like this. Receipt of retainer from client John Doe for matter number 1234. Check number 5678. A proper disbursement looks like this. Payment to ABC Court reporting for deposition transcript in due v. Row. Authorized by client email on June 5, 2026. The detail is your defense. And for every entry, you must have the corresponding documentation, the check image, the invoice, the client's authorization linked and instantly accessible. Second, you must maintain separate client ledgers. This is where the idea that it's not one big account becomes critically important. Think of your main trust bank account as a vault. Inside that vault, each client has their own locked box. You can't take money from one client's box to pay a bill for another. In your accounting system, this means having a distinct subledger for every single client. This subledger must show a running balance of that specific client's funds. This isn't just a good idea. It is a core requirement in virtually every jurisdiction. fees. Without it, it's impossible to prove you aren't accidentally using one client's money to cover another's expenses. Finally, enforce a zero-tolerance policy for negative client balances. This sounds obvious, but it happens all the time. You can never, under any circumstances, pay out more money for a client than that client has in their disbursing. Even $1 more means you have just used another client's money to cover the bill. This is a cardinal sign. The most common way this happens is by disbursing funds against the deposit that hasn't fully cleared. A client gives you a $20,000 check. You deposit it, your bank shows it as available. And you immediately cut a $15,000 check. Awake. The client's check bounces. The bank claws back the $20,000, but your $15,000 is already gone. That $15,000 shortfall was just covered by every other client's money in the account. You have now committed a massive violation. The rule is simple. Wait for funds to fully and finally clear before you treat them as available. Your software should help, but the ultimate control is human. Before any payment goes out, someone must physically look at that client's subledger and confirm the funds are sufficient and cleared. No exceptions. Daily habits are about getting the details right. The monthly process is about proving it all adds up perfectly. And this is where we hit the second major pitfall, the reconciliation nightmare. This is where firms that think they're doing a good job walk straight into a compliance buzzsaw. If they do, a standard bank reconciliation. They take the bank statement, check off transactions against their register, and when the numbers match, they file it away. From a compliance standpoint, that's dangerously incomplete. A standard bank reconciliation only proves your checkbook math is right. It doesn't prove you're holding the right amount for each client. It's a one-dimensional check in a three-dimensional world. The real standard, the one required by many state bars and legal regulators, is the three-way reconciliation. It's not just a best practice. In many jurisdictions, it's mandatory. As the CPA guiding the firm, it's your job to make sure this is done perfectly every single month. Let's break it down. A three-way reconciliation proves that three separate numbers are identical at the end of each month. Part. Reconcile the bank to the book. This is the step everyone knows. You take the bank statement's ending balance, add deposits in transit, and subtract outstanding checks. The result is your adjusted bank balance. This must match your accounting software's check, register, or the book balance. So far, so good. The mistake is stopping here. Part 2. Reconcile the book to the trust liability. Now we add another layer. The money in a trust account isn't the firm's asset. It's a liability. You owe that money to your clients on a firm's balance sheet. This is an account often called client trust liability. At the end of the month, this liability total must exactly match your adjusted bank balance from Part 1. If it doesn't, it means there's a bookkeeping error somewhere, transaction posted to the wrong account. A botched journal entry on your firm's own books are wrong. Part 3. Reconcile the trust liability to the sum of all client ledgers. This is the moment of truth. You take the ending balance from every single client's subledger, the individual locked boxes, and add them all up. That grand total, the sum of all individual client balances, must perfectly match the client trust liability total from Part 2. When those three numbers match adjusted bank balance, book liability, and total client ledger balances, you have a successful three-way reconciliation. You've created an auditable, defensible record that proves your integrity. And if they don't balance, you don't ignore it. You stop, investigate, and find the error now, while it's still fresh. Filing a reconciliation with an unexplained difference is an admission of failure. I know this is incredibly detailed, which is why I've created a comprehensive daily and monthly trust accounting. Section 3. The third and most dangerous complexity. The Commingling Catastrophe. We've covered daily records and the monthly three-way reconciliation. But there's one violation so fundamental that regulators have almost no tolerance for it. Commingling funds. Commingling is simply mixing client funds with the firm's money. In the eyes of an auditor, accidental commingling is just as bad as intentional theft. The moment firm money and client money touch, the integrity of the entire trust is broken. It usually happens accidentally. The most common way. A client's retainer check gets deposited into the firm's operating account by mistake. That's it. You've just commingled. Or maybe you pay a firm expense directly from the trust account, thinking you'll pay it back tomorrow. In that moment, you've committed a serious violation, but the most subtle and most dangerous form of commingling is leaving earned fees in the trust account. Let's say you do $5,000 of work for a client and send an invoice. That money is now earned. It belongs to the firm. Most bar rules require you to promptly transfer that exact amount from the trust account to your operating account. You let that $5,000 sit in the trust account for weeks or months. The account now contains a mix of client money and your money. You are commingling. The trust account is for client funds only. Period. The solution is to build an unyielding wall between your trust and operating funds, FERS. Use dedicated accounts, properly established IOLTA for client funds, and a completely separate operating account for the firm. Second, for any significant disbursement, use dual authorization. One person prepares the payment, and a second person reviews and approves it. This simple two-key system prevents both fraud and costly errors. Third, be disciplined about transferring earned fees. Once a fee is earned and invoiced, move it out. The transfer description should reference the invoice number, creating a clean audit trail. Don't let earned fees linger. Now, as CPAs, we deal with different kinds of trusts, and it's vital not to get them confused. Try IOLTA. The rules for a lawyer's IOLTA account are very different from the rules for, say, a formal estate or family trust. Legal trust accounting, like for an IOLTA account, is about short-term cash safeguarding. The main goal is tracking receipts and disbursements, and the biggest rule is the absolute ban on commingling. The audience is the state bar, and the key report is the monthly three-way reconciliation. Fiduciary accounting for an estate or long-term trust is about long-term asset management. It goes way beyond cash to include real estate and stocks, tracking income, and complex distributions. Free holiday. The audience is the probate court and the beneficiaries, and the reports are much more detailed. You have to know which game you're playing. Summary. So let's recap. The complexities of trust accounting really come down to busting 3 myths. First, this isn't simple bookkeeping. It's a daily process of meticulous, detailed documentation for every single transaction. Second, a simple bank reconciliation isn't enough. Your professional duty demands a full 3-way reconciliation every month, proving your bank, book, and client ledger balances are in perfect sync. And third, the separation between client and firm funds is absolute. Commingling, even by accident, is the cardinal sin. You prevented with dedicated accounts and strict transfer procedures. Conclusion. Look, I know this is a high-stakes, zero-error part of your work. It can feel overwhelming. But managing trust accounts isn't supposed to be easy. It's supposed to be right. By putting these rigorous systems in place, by treating trust accounting as a pillar of your professional integrity, you can navigate this field with total confidence. You can provide the best service to your clients, build an untouchable reputation, and protect the career you've worked so hard to build. Thanks for watching.